Hello, and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we're very pleased you joined us for our 11th annual banking conference. Our next live presentation is from Kish Bancorp. Please note you may submit questions for the presenters in the box to the left of the slides. You can also view a company's availability for one-on-one meetings by clicking Book Meeting in the top toolbar. At this point, I'm very pleased to welcome Gregory Hayes. He's the President and Chief Executive Officer, and Mark Cerverkal. He's the Treasurer and Chief Financial Officer of Kish Bancorp, which trades on the OTCQX Best Market under the symbol KISB. Welcome back, Greg and Mark.
Thank you for having us. We're excited to be here. We appreciate OTC and their support. We'll dive right into the presentation here, and then if there are any questions, we'll save some time at the end and address those. So I'll start obviously with our forward-looking statements disclosure. All of these information in here has forward-looking statements in them, and those risk factors. So that disclosure past us, we'll dive right in. Kish Bank is a fully diversified financial institution based in the central part of Pennsylvania, serving 5 counties around State College and Penn State University. We serve the agricultural markets, the rural markets, as well as some of the urban markets in State College, Blair County and Altoona, Huntington County, Mifflin County, and Juniata County. We also serve Northeastern Ohio with a loan production office based in Hudson. That's an office that does some specialty lending in the area of multifamily construction lending, as well as some other commercial real estate on a smaller percentage. We are a rapidly growing community bank in the center part of the state. We've been consistently growing, but we've been in business for over 125 years. We are very mission-driven, purpose-driven organization. We come to work every day because we believe we can make the lives of those around us better. And we do that by serving our clients with a human customer relationship supported by great technology and innovation. That focus has driven us through great people, great culture, and strong performance for our communities to support their local needs and businesses for many, many years. And what it's done is it's represented a doubling of the size of our bank over the last 5 years and over the previous 5 years. And that continued consistent growth comes from a focus on quality. It comes from a focus on the kind of credit quality that supports and sustains our shareholders' capital while delivering the lending needs of the organizations and communities around us. So we're now over just about 1.7 billion in total assets. Our market cap is about 107 million, and 2024 return on average equity was 12.23%. The focus on quality and growth really comes from the support of our shareholders and driving return for our shareholders. We're recognized nationally in American Banker's top performing banks based on ROE, number 3 in Pennsylvania, number 38 in the nation for average ROE over the last 3 years. And we've been recognized in this 15 of the last 16 years. So it's a consistent demonstration of performance that's recognized by American Banker. And it really is driven by our long-term focus on growth and quality. That's demonstrated by the very low level of loan delinquency and basically zero charge-offs and loan losses over the last 7 years. In 2017, we took advantage of the tax jobs cut or the Jobs and Tax Cut Act, and we've moved some things around, but the long-term performance of our portfolio is demonstrated in the fact that we've got very little charge-offs. That's aligned with the fact that we've grown loans significantly over a long period of time. Traditionally, you would see that kind of loan growth, you'd see some problem assets pick up, but we have not. We've maintained our level of loan quality and focus that drives the performance for our shareholders while growing loans. And that's a level of diligence and focus that has been really critical and important to our organization. We're supporting that kind of loan growth with deposit growth. grew 10% in deposits, 15% in our retail deposits last year. And you can see that in our market share numbers. While we've been located in Mifflin County, we're almost 50% market share in that market. That's the market in which we have grown up for over 125 years. But we've grown into Huntington County and Center County, where we're number 2 and 3 in market share. Center County is a $4.5 billion deposit market, and we're the 3rd largest institution, the largest community bank by far in that market. 2 new markets that we've moved into, Juniata County, which is a $600 million market, and Blair County, which is a $3.5 billion deposit market, represent big opportunities for us to continue to grow. We've moved into those markets within the last year and a half. We're already establishing strong market share and growing quickly in those markets as the community bank which folks resort to and go to for the kind of local service and relationship banking that they demand, really. As we've managed loan growth and loan quality, we've supported it with strong deposit growth. We've been able to manage a very stable net interest margin. We've done that because the kind of lending that we've done, the loan growth that we've done as interest rates shot up over the last several years, we were putting new loans on the books. We were putting variable rate loans on the books, which allowed our loans to reprice. We have a very sophisticated balance sheet management program. Mark can join us later if you have any questions relative to our net interest margin management, but very sophisticated balance sheet management with interest rate swaps and a balance sheet hedging, interest rate hedging program that Mark has brought to our organization, which is very sophisticated for a bank of our size. And it's been a critical part of being able to manage a very stable interest margin. We like to manage the bank such that rates go up significantly or go down significantly. Our net income is still going to be pretty steady. We're not going to be impacted either way. And that has allowed us to manage a very stable margin, but also a very strong margin because of our growth in loans and the support from the deposit side. That produces really strong net income. Net interest income on the bank side, but that's not our only source of income. We're more than a bank. We're very entrepreneurial. First bank in Pennsylvania to acquire a property casualty insurance agency in the 90s when that legislation changed. And so we're a fully diversified financial services company. And the result of that is that we receive 20% of our net operating income actually comes from fee and non-interest income. And so we've been a disciplined acquirer of non-bank businesses, insurance agencies, wealth practices, and that has helped us support the growth in interest income with our non-interest income. In fact, when we look at our lines of business, banking, wealth management, insurance, benefits consulting, and travel, it represents a full suite of services so that as businesses and the residents of our communities come to us for a need, we easily align across all of our business lines through strong relationship-based consultative support for their needs. And it's a natural connection between products and services and helping people not only grow their assets, but protect them. That bank and non-bank fee income you can see here has grown steadily. While the core engine of the bank has grown at such a rapid pace, it's been hard for our non-bank units to keep up, especially with the slowdown in the mortgage market following the boom in mortgages in 2020 and 2021, and then the refinance boom in 2022. We did see a significant decline in secondary market fee income. Mortgages that were traditionally being sold in the secondary market, we saw $500,000 in decline in mortgage sale income, but we've supported that with significant growth in wealth management, growth in insurance. We acquired an insurance agency around 2021, and that has all been very supportive of continuing our focus on non-bank fee income, which you can see here. The net result is strong growth in net income, a compounded 15% annual growth rate over the last 5 years. We have doubled our net income over 5 years, and it's a testament to the quality of our growth, the very diligent focus on doing it the right way with great people delivering great services, and you can see the long-term effect of that is it creates more stability for continued growth as we go forward. That results in shareholder performance. Our focus on return on equity comes from our management of the quality of our assets, and it develops that return for our shareholders. But it's also the earnings per share that we drive. Strong earnings per share at $5.13 in 2024, and a share price of $34.75 as of mid-February. We've got a market valuation of equal with tangible book. That's we believe below where we should be. We've provided a consistent dividend. We've increased that dividend 10 out of the last 11 years. It's currently 4.49% and a very attractive PE of 6.7% or 6.7 times. That price to earnings ratio really demonstrates, and it's a reason we're so active in getting our message out there. Consistent, strong performance is not necessarily being currently reflected in our stock price. Our book value per share is $35.98, but our earnings and dividends per share are really strong. And what we're focused on is communicating this message. And as we've done that, we've seen a nice increase in the volume and trade of our stock. When we look at the 10-year total return, we see a long-term performance versus the total return of S&P Bank Index. Kish is at 158% over 10 years, including our strong dividend and stock appreciation. But when we look at our stock more recently, it's been this increase in focusing on getting our message out. You can see up and through the mid part of 2024, the trade volume was very low. But when we started, we've been out focused on the investor conferences and getting visibility to our performance that has demonstrated a higher level of volume, higher level of trades. Recently, as much as a couple days ago, we had 16,000 shares trade. You can see the increased volume, and it's starting to reflect in the price as well. And it's our belief that if we continue to tell the story, continue to show the strong performance that we have shown over time, shareholders will see that, and the price to earnings value or ratio will get more in line with traditional PE ratios in the 8 to 9 or 10 range. And so with that focus, we really want to make sure we're out with the story. We're talking about why an investment in Kish Bank could be meaningful. And it really comes down to consistent long-term share earnings trajectory, shareholder performance, our ROE, our net income growth, our dividend expansion over the years, and our diversified revenue stream, plus the attractive PE ratio. The upside for Kish Bank stock for KISB is what you see in that PE ratio, what you see in those charts. It's a real opportunity. And as we've gotten the message out there, you can see some of the appreciation that's occurred in that short period of time. We have leading market share and excellent growth potential. In the markets we have served for a long time, you can see our consistent performance has resulted in market share. As we continue to grow, State College represents Center County, a $4.5 billion market, represents a continued opportunity for us. But our movement into Blair County and Juniata County represent terrific opportunities as well. They are, Blair County being a large market, we being a community bank, are demonstrating that we can hire the talent and deliver the services that those communities really want. I want to talk just a moment about the opportunity that exists with Northeastern Ohio. In 2020, we had been managing participations with a group of lenders in that market that were with another institution that went through an acquisition. They really liked our credit culture. They really liked our focus and our energy and our core employee culture as well. And they decided to join us in late 2020. And through that period of time from 21 to until today, they've represented a significant part of loan growth for us. And our opportunity to wrap around that specialty lending group, a broader set of our services, C&I lending, deposit gathering, treasury management, retail lending, mortgage. It's a great market for the kind of service that we offer, and we're seeing great potential in that market as well. The other significant opportunity for us for growth is the fact that a lot of our fellow community banks have sold recently, or there's a planned merger going through, and we continue to get phone calls from clients who don't want to be a number at a larger institution. And it is a significant part of our opportunity to grow. You can see in the markets where we've got 40, 50% market share, we thought we couldn't grow more, and we continue to grow. We continue to gain market share, even in markets that are not growing, because we're pulling market share from other institutions through our ability to demonstrate that we can deliver. And so that focus on growth has really been the core engine for our success, and it will continue to be that as we see disruption in the market. We are clearly differentiated. Our focus on small business, on professionals, high net worth clients, nonprofits, we're out with products and services and the delivery that those clients expect with a very relationship-based approach. We also have a focus on delivering a diversified approach across all the banking units that I mentioned: banking, trust, wealth, insurance, benefits consulting. That allows us to diversify our income stream and continue to support and manage the ebbs and flows of the banking industry, of the interest rate environment and whatnot. With a strong service focus, high quality credit, and sophisticated balance sheet management, we are clearly differentiated from community banks around us and our peers. But as we look going forward, it really is in our technology and innovation focus that we see tremendous opportunity in where we're thriving. Those opportunities to grow are represented by our new retail delivery model. As we go into more rural markets, we can't do that with a full service branch with a traditional overhead structure of 4 or 5 tellers and a branch manager and a lender. These are not markets that can support that from a transaction standpoint, especially when the majority of transactions are occurring via digital technology, which we continue to innovate and stay very competitive with. And so our capacity to go into those markets with very human-centric technology, our live banker capabilities, where you take a traditional ATM, you drive up to the ATM or walk up to the ATM and you tap on the screen and you get a live human. That human takes over the machine, and you can cash a check, you can make a deposit, you can make loan payments, you can split your deposit into multiple accounts. It's very exciting for our rural communities who've consistently seen the larger banks closing branches and pulling out of their communities. We're going into those communities. We're going into those communities with one banker, one relationship, and the technology and transaction capacity to support their needs that they're used to on a day-to-day basis without the massive overhead structure of a traditional bank. That transformation is allowing us to expand our capacity to deliver human relationships across our network. And the construction of our innovation center in 2020 represents a tremendous anchor for us to deliver those services, where we have all of our team located centrally, innovating and delivering the kind of capabilities and human-enabled technology. Not technology-enabled humans, but it starts with the human, and we wrap the technology around them, whether it's video chat in your digital banking or video capabilities for transaction activity. It really is a huge opportunity for us to deliver more experience and more access to humans across a broader network. So with that, I'm going to transition to questions. I'm going to ask Mark Zervikel, our Chief Financial Officer and Treasurer, to join me if there are any questions that he would like to answer. And we will open it up. There are a few questions here that I'm going to cover. The first question came in is asking, actually, it may have been the last question to come in. I'm starting from the bottom. Regional headwinds that may impact our business. The question is a good one. We are fairly well insulated, but the things that are going on in the industry today, we can ask Mark to speak relative to the impact of tariffs, but we talk to a lot of our manufacturers in our markets who are seeing significant rise in costs of diamond plate steel. Just spoke with an auto dealer this morning who's dealing with, now they have a 1-month reprieve on the tariffs, but almost every car part or sometimes the entire vehicle are coming through either Canada or Mexico. And we see disruption coming, but in every moment and period of disruption we have witnessed in the past, we have been there, and we've been a source of support for our community to help them through those periods of time. So we see it as an opportunity. We are watching those headwinds. We manage our enterprise risk very closely, the correlation between potential risks that may come. So we're working through it, but the biggest headwinds we see in a fairly insulated market, we've got agricultural, which is a small portion of our market. We have a large multifamily residential construction lending portfolio. The majority of those deals are structured very well with very strong sponsors and guarantors on those projects. We look at over $1 billion in deals a year, and we only take a very small portion of them, maybe 100 million or so. Very picky, and we look at every property. We visit every site. We make sure that we're going to manage the risk associated with that. And so as those headwinds come up, we'll continue to manage them, we'll continue to monitor them, and their potential impact. We continue to see strong capacity to repay. Our delinquencies are very steady. We may see a small amount of marginal increase in delinquencies on the consumer side, but most of our commercial relationships, there's still a ton of cash out there. A lot of our business they're sitting very well positioned for potential economic downturn, and we continue to monitor that. We're in a good position if interest rates either go up or down. We'd like to see the yield curve normalize a bit, which I think we've seen this week, but it's across the board something that we continue to manage. Mark, did you want to add anything? We've got a bunch more questions coming in here, so I want to keep rolling.
No, I think one point you make, Greg, is the flexibility in our balance sheet and how we hedge our balance sheet for any changes in interest rates. And actually, if rates go up, rates go down, there's a less than a 1% difference in net interest income. So I think that's pretty strong for a small community bank. And the way we do that is through our hedging.
Yep, very sophisticated. There's a question here. Do we have any plans for dividend and buybacks this year? We continue to manage capital very tightly. Our board does authorize us to buy back stock. We buy stock into Treasury to support numerous activities, but we also have in place programs for stock buybacks. From a dividend standpoint, we just raised our dividend at the end of last year. It has been a consistent focus for us to continue to support our shareholders through strong dividends. We don't foresee any changes in that regard. There's a question that if there is anyone interested in buying stock, who should they contact? Should they contact us directly? Yes, we have market makers as at Raymond James and at Janney available on our investor relations website, but you can contact us directly. There's oftentimes with a locally held or closely held publicly traded institution like Kish, we may be aware of folks who have a small block of stock to sell that we can put people in contact with our market makers to manage that. Mark, could you touch on the derivatives, which is unique for a bank of our size.
Yeah, it is kind of unique. We have really $158 million of balance sheet swaps. And what we end up doing, we borrow 3 months from the Federal Home Loan Bank. Then we extend it out for any time period we feel appropriate for the balance sheet. And I'll give you, for instance, in August, we saw the weak unemployment number come out. Rates went down substantially. We executed a trade in an amount of $34 million. And we ended up getting 5-year money at 3.3%. That was actually 20 basis points under Treasury rates at that time. So that gives us the opportunity to get low-cost, long-term funding. In addition, what we do, we sell swaps to our commercial customers, and it gives them the ability to fix their long-term debt service cost. That way, it's a variable rate asset for us, fixed rate debt service for them, and we take some fee income on that, which is also increases the bottom line. Very few banks under $3 billion, $4 billion actually have the derivative expertise that we do.
All right, there's another question here. Do we anticipate any regulatory changes that will impact our performance? Obviously, there's a lot of talk of deregulation or paring back regulations. We don't anticipate any immediate benefit from that. There is a few pieces of legislation that could be significant. There's currently an acres bill out there, which is a rural and agricultural tax incentive legislation that could significantly aid our ability to provide lending to those markets, especially from a competitiveness with farm credit. It's basically extending the tax credit that exists for farm credit in our local agricultural communities for communities under 2,500 residents. It's home mortgages, it's agricultural loans, farm-based lending. And that ability for us to offer this a similar product to farm credit when farm credit may not have a physical presence in our community will really benefit the community as well as create some growth for us. There's numerous other things we're monitoring and tracking relative to regulatory shifts. We are hopeful that the compliance burden and the overreach of some of the regulatory constraints that have come into play we're hopeful that those things happen and are able to kind of allow us to do what we do and go out and help our local communities with the kind of lending and activity that we should be doing. The other piece of that is we anticipate more pressure from unregulated industries. And so we're continuing to be very focused on how we stay relevant and competitive with the non-bank units, whether it's mortgage lending or consumer finance or consumer deposit products, small business lending, small business deposit products. Those are products that non-bank fintech entities are really trying to get in. The point is we've got the relationship. And so we're constantly looking at opportunities where we can bring a technology or a capability or an improved process to our customers. But it really does come down to who do they know and who do they trust. The people who bank with us because they know us and they can come talk to us. And that will always be a significant advantage for us. We've got the best people and we put them in front of our clients, whether we're selling our product or our mortgage or secondary market mortgage, they're still coming to us, and we think that we will always have the relationship. It's a matter of how do we bring those non-bank products or fintech products to our clients, and so we're very focused on that in our technology evolution. I believe that's all the questions. There might be a few more here. If we didn't get to your question, we will answer it and put it and get back to you. If you do want to contact us, book a meeting with us, please reach out. We'd love to have a conversation. We're happy to go into far more detail on any of the information. We had 45 total slides. I only shared 20 of them with you in the 20 minutes we had. But I want to thank OTC, and I want to thank all of you for joining us today. We appreciate it, and talk to you soon.